All right, welcome back everyone to Nadlan Forum Podcast Daily. I'm Ruby Sturt, and as always, I've got Lior here with me. Hey Lior, how's it going?
Hey Ruby, all good, all good. Feels like deja vu lately. Mortgage rates are giving everyone whiplash.
Yeah, honestly, it's like the rates have got a mind of their own. So let's lay it out. Last week, first we dipped down to these historic lows, 6.125% on the 30-year fixed. That's like almost the lowest in the last year, if I'm not mixing things up here.
No, you're totally right. But then, boom, the Fed drops their rate, just as everyone kind of expected. But instead of everything settling, we get this jolt upward. I mean, mortgage rates were all over the place. Shot up after Jerome Powell's speech midweek, and even more after Thursday's data came out.
Yeah, wild. And like that wasn't just theoretical. One of my friends, she was literally right in the middle of trying to lock her mortgage. Her lender quoted her, I think, 6.15% on Tuesday. She hesitated for a day, just one day, and by Wednesday afternoon, they'd bumped her up more than a quarter point. Talk about rotten timing. She was almost in tears. Then as the week wrapped up, things cooled off again and rates slipped back closer to where they started. But I mean, try telling that to someone who just missed the window by a few hours.
Yeah, that's classic market volatility. You can be ready, you can do your homework, and then a speech from Powell or a bit of surprising economic data. Suddenly, everything changes. And I want to remind people, even though rates steadied out by Friday, a week like that just shows how sensitive the whole system is to every headline and Fed statement.
And I think people are always surprised when rates jump around like that. A lot of folks just assume the Fed cut rates, that means mortgages go lower. But that's not really what happens, right?
Yeah, I hear that all the time in my work. Look, the Fed sets the short-term benchmark rate, but mortgage rates, they mostly follow the bond market, specifically the 10-year Treasury yield. These rates will jump when investors think inflation's coming, the economy's heating up, or future Fed policy will be, more aggressive than expected. Doesn't matter what the headline number is.
Basically, the bond market's got its own opinions, and sometimes they just ignore what the Fed does on paper. I mean, last week was a perfect example. The Fed eases up, but then investors hear Powell talk. Suddenly, everyone's bracing for more inflation down the line. Boom, bond yields go up, and so do mortgage rates.
Exactly. And let me give you a quick story. I had a client in New York. This was just last month. We were watching every move, waiting for good data to hopefully lock a better mortgage rate. There's a Treasury auction, right? Bond yields spike, completely out of the blue. Their rate offer gets repriced, not because the Fed did anything new, but just because the mood in the bond market flipped. They almost lost their deal over, honestly. A tiny technicality in the auction. You got to watch the bigger picture, expectations, headlines, everything with this stuff.
Yeah, I remember we talked about this in episode 7 too. It's not a straight line from the Fed to your mortgage payment. Market sentiment, inflation expectations, global news. Sometimes it's like herding cats. No single piece of news gives you the whole story.
So, looking ahead now, all eyes are basically on the jobs report, which drops this Friday. People underestimate how strongly employment numbers can move mortgage rates. Good jobs report? It signals growth, but also maybe that inflation pressure stays, so rates react. Bad jobs report? Bond yields drop, and hopefully so do mortgage rates.
And it's not just the jobs report. We've got a parade of Fed speakers all week. Every time one of them opens their mouth, the markets can lurch all over again. It's a bit like, what's that thing in showbiz? Oh, right, the curtain call effect. You think the show's over, then someone comes out for an encore and the crowd loses it. Can happen 3 times in a day with the Fed.
Yeah? And for anyone thinking about buying or refinancing, the question is always, should I lock my rate now or wait for another dip? I wish I had a crystal ball. But really, The risk is you wait, hoping for a better number after the jobs report or a Fed speech, and the market moves against you. Sometimes it's better to take the certainty, especially in a week where we know volatility is coming.
Yeah, and as we saw last week, even a fraction of a percent can mean thousands of dollars in the long run. So I guess the takeaway for listeners is watch the key data, know your own risk tolerance, and, well, don't wait forever expecting rates to magically hit a record low just for you. That's like holding out for the Aussie dollar to be worth like $2 US. Not happening, mates.
Totally right. This week's got a bit of calm so far, but any bit of news could shake that up again. Just stay informed and talk to your lender if you're in the game right now.
And if you want more updates like this, stick with us. We're tracking these twists and turns every day. Lior, always a pleasure. Shall we call it for now?
Definitely. Thanks, Ruby, and thanks everyone for listening. See you next time.
Catch you next episode, folks. Cheers.